A 10% interest rate limit on credit cards sounds like a win for consumers until you look at who actually pays the price. Donald Trump recently floated the idea of capping credit card rates at 10%. On the surface, it feels like a relief for people drowning in high interest debt. I'm Quay Parker. I spent over 20 years in lending and helped more than 1,000 families buy homes. And I've seen what happens firsthand when well-intentioned policies ignore how credit actually works. See, lenders don't just set rates to be greedy. Rates are how risk get priced. When you cap the price, lenders don't become generous, they become selective. Borrowers with strong credit still qualify and still get access. But people rebuilding credit, they're the ones first cut off. That shows up as fewer approvals, lower credit limits, and stricter underwriting standards. And here's the part most people miss. Limited access to revolving credit doesn't just affect spending, it affects your future buying power. See, credit cards are one of the primary tools people use to establish, repair, and demonstrate responsible credit behavior. Remove access to that tool, and you make it harder, not easier, to qualify for things like a mortgage. So while the policy sounds good in the headline, the real-world outcome is tighter credit, fewer on-ramps, and a wider gap between those who already qualify and those trying to get there. Intentions sound good, but outcomes are what really matter.